Today, we're going to talk about how to get it right with a whole life insurance policy. We're going to walk through a real life situation. It's based on an individual who has been really researching whole life insurance. He's interested in it for the cash value. The death benefit's important as well, but he's a little bit later in life. He's 51 years old. He owns a few businesses, and he's at a point in his life now where things are really starting to pick up, really based on his reputation. He's a really, really nice guy. People trust him. They know if they ask him to complete a job, he's going to be very thorough, and now he's experiencing the benefits of that, the dividends. His business is thriving as a result. So he's interested in a whole life insurance policy to save money for retirement, but not just that. Something that's very important to him is having access to his money, to the cash value that he's going to build in the policy for opportunities, for his business. So a little bit on him first. We mentioned that he is 51 years old. He does several things. He is a real estate broker. He is a real estate investor. Like I can save time with technology. But here's his main business. He owns a construction company. And he just got a big contract where he knows that he'll be able to heavily fund the policy for a while, for several years as a result. So what he's interested in with respect to a whole life insurance policy is as follows. He likes whole life insurance, number one, because it's a safe place he can put money. So talking about the safety, like what makes a whole life insurance policy safe? And again, this is an emphasis on the cash value. Why do people do this, or what is he interested in? Well, when you look at the cash value of a whole life insurance policy, no matter what happens in the stock market, in the economy, the cash value continues to appreciate, unless it's designed poorly, we mess something up in the beginning. But if you do everything right, which is easy to do, you'll see your cash value continue to appreciate over time. Your money is positioned with the insurance company that you select and really where they are investing the money. And if you're with one of the top mutual companies that have paid the guaranteed rate that they offer, plus more, which is the total dividend interest rate, we've always seen the values go up, which is exactly what we want to see. So insurance companies invest in a variety of things. Historically, we've seen them invest aggressively or heavily in bonds because it's a safe place to put money. As bond yields have come down and become less attractive over time, long-term AAA bonds that is, we've seen them invest in other areas such as high-end commercial real estate. They acquire partially or fully other companies, other businesses. They're looking for safe places to put their money where they can drive an attractive return without taking on any risk. That's what they're looking for. But what we see with a cash value life insurance policy is no matter what happens, it continues to appreciate over time without any risk. The net growth rate will fall likely somewhere between 3 to 5%. So he's interested in the safety. This is one reason why he's interested in a whole life insurance policy. The safety. Second reason is the liquidity, having access to his cash value anytime. He wants to be able to use it for his business and also for retirement down the road. So this has to do specifically with policy loans. When you take a policy loan, as long as we don't trigger a MEC or another taxable event, we can access it tax-free. Also, in retirement, you don't have to pay loans back. So when you hear of people generating tax-free retirement income with cash value life insurance, what they're often doing, or what they're always doing, is taking policy loans, especially when they've taken more money out than what they've paid in, and they're not paying it back. How you do that is the loan interest when it comes due is the cash value, the earnings just satisfy that. The death benefit is also deducted by the amount that is billed in loan interest, but you're not paying it. So in a sense, you do pay for it eventually when you die because you leave a lesser death benefit down the road. But it is something that's been practiced for a long time. A lot of corporations will do it when they create retirement benefits, or it's almost like a pension income for their executives when they retire. That's a whole nother topic. My point is, we've seen it go on for a long time, which is pretty cool. But with loans, it's a great way to generate tax-free retirement income. And in addition to that, when you borrow against a policy, your money keeps on compounding. So he wants to be able to use it for his business. A lot of people will do exactly this. If you've got cash value of 100 grand in your policy, and that's earning a dividend rate of 6%, just for simplicity. If you take a loan, let's say for $50,000, what do you earn that dividend on? Is it only your remaining cash value? Because when you take that $50,000 loan, you're going to see on your online account for your policy, net cash value available to borrow is $50K. Because you pulled a $50K loan. When you take money out, it reduces how much you can take in additional loans, just like a line of credit against property. That dividend rate, though, of 6%, even though you borrowed against it, is still applied on the full $100,000. Now, some companies might apply a dividend rate that's a little bit different. You'll hear the term non-direct and direct recognition. Typically doesn't make much difference at all when you look at the actual numbers. My point is, you continue to receive compounding on the full $100,000, even though the money's outstanding. Now, to be fair, you're going to have a cost to borrow, which you're going to pay to the insurance company in this strategy, which will somewhat offset the benefit there. But typically, if you do this right, and you've had a policy for a couple years when you're beyond the early years where you've got that negative hit, this works quite well, and a lot of people are attracted to cash value life insurance for this reason. Where I see business owners attracted to it is because this speed, if I've got an opportunity where I would normally finance with a bank or have to use cash on hand, if I've got the money in the policy, I can access it very quickly. I typically get a loan within 2 to 3 business days. That's the average turnaround time, and that's it. I don't have to apply for a loan. I don't have to talk to any loan officers or anything like that. I can pay it back however I'd like. So I don't have to deal with everything that I would normally deal with a bank or a lending institution. I can move a lot quicker. And when I pay it back, I see that my money has constantly worked for me the whole time. It's a nice benefit there where a lot of people say, okay, I like this strategy instead of just refilling the bank account or having to deal with the bank, because sometimes things just get delayed. And it's always up to you as the individual. Usually we'll see people still keep banking relationships, but they like this policy as a backup. And as it gets bigger, it typically becomes their primary source of financing. So a lot of info there, but he was interested in that, or he is interested in that. It's a big reason why he's funding a policy with a large dollar amount. We'll get into that in a second. The third benefit, here we go. Big one here. Do everything right, it's tax-free. So check out the above video if you want specifics on how you could not do everything right and mess up the tax advantages of this policy. But it's very easy to do things right and prevent a taxable event. So what he is looking for in a policy, what he does not want is a policy where he says, I want to buy a life insurance policy. How much is it going to cost me? No, that's the last thing I would recommend if you're interested in a policy for high cash value. Here's how I would do it. I would first ask, how much would you like to fund this policy? On any given year, what is the maximum dollar amount you'd like to be able to pay into this policy? He said, on a good year, Steve, I could do $100K. And that is realistic for him. So writing a check for $100,000 per year into a life insurance policy, why would you do that where cash value is your goal? Well, what we want to make sure of here is that the cash value is truly maximized. So of that $100,000, I would not just buy a life insurance policy. If you do that, you're going to see zero in cash value in the first year. Here's what I would do. So with your policy, you can choose where that 100K goes. Two main areas. First, your insurance premium. And then second, what is called your PUA rider. PUA stands for paid up additions. What the English translation of these two? I like to call the premium the initial insurance expense, and then the PUA rider, I like to call it cash dump in. Here's why. So what is he interested in? What are you interested in if this is you? This guy. Cash value, okay. Any money you pay into the premium piece of the policy, guess how much shows up in cash value? Zero. Is it zero every year? Just the first year with the product we're going to look at. Why do you get zero of the premium in the first year? Like, why does that actually happen? The reason why is because this is a life insurance policy. Even if you said, I don't care about the life insurance, which we hear quite a bit, premium dollars primarily purchase a death benefit, life insurance initially. The way I like to explain it is what the insurance company does with a whole life insurance policy is really overcharge us for the cost of insurance or the death benefit up front. The insurance expenses are the heaviest in the first year. PUA rider, guess what happens here? Shows up in cash value. It will get you some death benefit too, but you'll see in the first year, usually somewhere between 90 and 95% of that, the PUA payment alone, shows up in cash value. So we want to dump the majority of our payment, where? To the premium? No, because it won't show up in cash value immediately, into the PUA rider. Here we go. So how low can I go on the premium? You'll find with a lot of the top companies, we can often drive it to 10% of the total. So if I want to be able to fund $100,000 per year, that's the maximum amount he wants to add on any given year. That means, knowing the rules of the game, I can set that premium as low as $10,000. I'm going to show you the exact illustration too in a little bit. What this also does though, for someone that owns a business, right, so he's got 3 businesses going on. If you are in any of these businesses, is cash flow stable? Does it come in on a consistent basis every single month? You know exactly what you're going to get? No, especially if you're in sales. You know that's not the case. Some months are fantastic. Other months, not so much. Point. Would you want a bill for $100,000 or any dollar amount? Probably not. So when you've got these two areas here, you've got the premium at 10%. Guess what he's committed to or locked into? The premium piece. The PUA piece. Does he have to pay that? If this is you, do you have to add that extra $90,000 every year? No. It's optional. Now, if you don't, it will impact the performance, which, of course, we want to make sure we show you exactly what that looks like. But my point is, it's very flexible. And where a lot of people like this is when they think that their cash flow is going to come in. Someone says, no, I know I'm going to be able to do this. Over the past several years, the money's been coming in. I'm confident that I can do that. The timing, though, never lines up. It's never what I think it's going to be. So this type of setup allows me to have a lot of flexibility. This is exactly what he did. To take it a step further, what he said was this: can I set it up where this $10,000, I just pay it monthly? So that's about what, $833 a month? Like, can I just do that and then at my discretion add more money into PUAs? The answer is yes. Now, the insurance company selection is important here because not all companies are going to let you do that. He went, after we looked at a couple options, he went with Guardian. Two reasons why. One, they're a major mutual company, meaning we've seen proof of actual performance. And two, they're very flexible. They allow a design like this where he can commit to a minimum premium and then just add more money at his discretion. So we're going to look at what his plan is. His plan is to fund that $100K per year for 10 years. It's a total of $1 million. And after he starts his, he wants to do the exact same thing for his wife. So $100K per year, that's $200,000 total. Then he also wants to take out two policies or one policy for each of his two children. So he's planning on pumping a lot of money into these products, but having access to the cash value in case he wants access to it or if he needs access to it, that's important, but then for retirement. Like that's a big, big reason why. He wants to start building up retirement, making up for lost time, and he's in a position now that he's owned a business for several years and it's cash flowing because he's really established a solid reputation where he works, people trust him. Now he can really make up for lost time and save 6 figures per year just into this. He's got other things going on too. He invests in real estate, but he likes this because it's similar to what he does in the sense just putting money somewhere safe and liquid, cash in the bank. I can put it here. Growth is a little bit stronger. I've got life insurance as well. I can access it and the money keeps on moving forward and the tax benefit is sweet. All right, you can tell I like this stuff too much. Let's take a look at his illustration here. So you'll see exactly how we set him up. I just want to start with a breakdown of where his money is going. Because if you ever consider a life insurance policy, you're going to be shown an illustration, and they're going to look different depending on what insurance company you look at. Here's how much we're illustrating. So we're going to assume he funds his policy with $100,000 per year for 10 years. That's a total out of pocket of $1 million. If I'm you, what I would ask is this: where? Where is my money going specifically? Because if we go back to the whiteboard, where can your money go? There's two main areas. The first one was in red. Do you remember what it was? Premium. What was the second one? It was in purple. It's called PUA rider. It stands for paid up additions rider. There it is spelled out on this illustration. Not all companies use that term, by the way. Some companies have different terms which mean the exact same thing. Just in case you're looking at your illustration and saying, where's my PUA rider? It's probably there. I hope it's there at least. Okay, so here you've got the premium at about $9,000. Then you've got your PUA rider, $9,000 and change. What we did here is what? 10x the base premium in PUAs is what we went for, because that's the maximum we can illustrate, meaning when we put this policy together, the software doesn't allow us to illustrate more than 10x the premium in PUAs every year. Except for the first year, they allow a large extra amount, but aside from that, 10x is the most. So how we set up the policy is in a manner where he is committed to this, plus this. What this is, the term insurance rider, prevents a MEC from occurring. If you'd like more information on that, I would check out our policy design video above. But point is, the minimum commitment, the $9,000 plus the $1,400, a little bit more than 10 grand per year, almost $10,500. When we pull this up on Excel, we're just going to round to $10,000. But when we look at a breakdown of where the money is going, the true minimum out of pocket is the $9K base plus the $1,400 term rider. That's what he can commit to each year, and then the PUAs can be added at his discretion. And that's exactly what he wants. He does not want it set up where he's forced to pay $100K per year. He wants it set up where he's forced to pay the minimum amount possible. This way it doesn't bother him at all. He feels like he can hit that minimum in his sleep, but then still be able to pour more money into the policy. So as we look at this, here we go. This chart will show him paying $100K per year. Stereo instructions, right? $100K per year, net premium. The column to the right is the exact same thing. The next column, cumulative net after-tax outlay, tallies up all of your payments. So if you do $100K every year for 10 straight years, you've paid in $1 million. I like this column. Like, where it can really help is if you're trying to figure out when your break-even point is, because you can look at this and go cross-eyed sometimes, right? Not fun. There you go. By the fourth year, you've paid in $400. Your net cash value, which is your money column, is positive year 4. That's when you break even or get all of your money back. So we've got a policy here that is cash rich right out of the gates, breaks even early. This way he has access to his capital. It's also set up to be very flexible, where he's committed to a small amount and then can add extra funds at his discretion. And then he has access to the cash value for opportunities, which we would look at our loan workbook and help him make informed decisions with seeing the numbers before he actually does that. That's something we do with people we work with as the years pass, or show them how to use the loan workbook we created, and they do it on their own. Now, he did ask about the net returns on his policy. He said, what's the internal rate of return? I'd like to see it. Because he knows that the dividend rate with this company is 5.9%. But he also knows that that's not what his money is actually growing by. Here's how you can tell, actually, without getting fancy. Look at your cash value down here at year 10. You're at $1,159,000. The next year, you pay nothing in year 11. 0. There's no premium due in this example because we eliminated it. So you're at 1,159. Next year, the cash value is 1.208 million. The dividend rate on this illustration is 5.9%. Take your number, 1,159,062 times 5.9%. $68,000 in change. Add that now to the 1,159. So plus 1,159,062. What we did, so I can walk you through this. So we took what our cash value was, took 5.9% of that number. That gave us $68,000 in change. Then we want to add the 68K to the 1,159 and change. And that gives us 1.227. What do you have? Less than that. So if you want to know what your net return is on a life insurance policy, the dividend rate won't tell you that. Don't ask for the dividend rate. What I like to ask, or like what I would ask if I'm someone requesting that information from my agent, I would say, what was the net growth rate? Or if I want to talk the insurance company's language, I would say, hey, can you show me the yearly rate of return or the internal rate of return on my cash value? That's what I'd like to see. And also, just to set expectations properly, you might not get it right away, and it will not be the agent's fault. A lot of times, insurance companies don't even provide that. So what we'll do when we work with people that have policies or have had them for a long time, if we're trying to see the returns that have already happened, is we'll pull what actually happened, the annual statements. We'll look at what they paid into the policy each year and then calculate the returns. We'll put it on Excel. With a new illustration like this, what we'll do is drop it on Excel and do this. So here's his policy and an answer to his question. Annual IRR, which is just the yearly growth rate. Here's my favorite thing to highlight, by the way. What's the drawback? First year, negative 12.46%. That's so important to cover. The reason why is because so many times we see a dividend interest rate or a guaranteed rate and think that our money is going to grow by that. No, if I put in 100K and have 87.5, that's a negative hit. One of the things that drives me nuts is when someone shows an illustration and says, hey, in the first year, you put in 100K, your cash value was 85K. But by the end of the first year, now your cash value is 87.5. So you gained $2,500 this year. No, you lost $12,500 of the 100K you paid in. Maybe you reduced the loss by $2,500 if you started out at 15 and now you're at 12.5, but you're still in the red. Like, it's people's money. We don't want to say, look at what you made up for, just try and focus on the good. Like, no, here's the net number when we look at it. In my opinion, that's how I prefer to highlight it, because it's more transparent and we can set expectations properly. Then the next year, well, at the end of the first year, you're at 87.5. You're paying 100 net. The cash value is now 189 and change. If you add 100 to 87.5, what would you have? 187.5. You've got more than that. That's why the net growth rate is positive. You're no longer in the red. But this shows what the policy is growing by net year over year. It also highlights the drawback, which is the early years of the policy. The first year is the worst year, and it still takes some time to make up for it as the years pass. And then we want to factor in the cost to borrow too, if that's something that's important to us. But that's the kind of stuff we want to look at here. And the last thing we'll do sometimes is show the growth in dollars. For those that prefer dollars instead of percentages. So 0.083% is $1,500. I see a different color here. How about light blue? Except for the first year. That's red. So to summarize, what we did for him is we set him up with a policy where he can save $100,000 per year. His goal is to position money somewhere safe so he can save for retirement, but then two, have access to it as a line of credit specifically for his business. And then the third isn't really a goal, but it's an attractive feature, which is the tax-free piece. So that's the why as to why he's interested in whole life insurance. What he is not interested in is being committed to a big old bill. Like, no, I don't want that. And I don't want to just be price quoted either. What I want is a policy where I can save money at my discretion. I can build the cash value at my discretion when my cash flow calls for it, and I feel comfortable doing so. I want that type of policy. So that's why we selected the particular company and product that we did. And that's what we always like to emphasize first. How do we maximize the cash value? Because if I do that, everything else that I do when it comes to borrowing against the policy or taking income, whatever it might be, if the cash value is maximized, I just have more money to work with for everything else. So that's why we always like to encourage individuals to start there. Because if I skip that step, that's where I find out that I was set up with some policy with a big base premium and it's difficult to change afterwards. It's like, man, now I just lost all this money in the beginning. It's like, no, I don't want that. So anyway, I hope this helps. Let us know your thoughts, and if you have any questions at all, if you are interested in connecting, you can check out our website at ibcglobalinc.com, or you can call or email us as well. And again, as always, I hope this helps. Thanks so much for watching.